Level 4 is to buy something that's absolutely cheap rather than relative. So we talked a lot about relative valuations and being relatively cheap compared to the history or to peers or to the market. But to pay absolute cheap valuations, that means that it doesn't matter what happens on the market in the future or if you can find another buyer. If the stock is absolutely cheap, if you hold it forever, you have the right to all cash flows and profits produced by that company. And that means that if that sum of cash flows is higher than what you paid, which is the definition of being absolutely cheap, then you will make money. You will make a good return. The thing is, it might be your grandchildren that get that return, but it's still there. It's baked in the cake from the beginning. If you paid a low enough price, a price that is lower than a risk-adjusted real sum of future cash flows. That is what it means to buy absolutely cheap stuff. And this can also be summed up in terms of valuation multiples. For example, for the entire market, if you pay 15 times earnings, and the growth rates and profitability and cash conversion and all these important key factors, if they are the same on average as they have been over 100 years of history, then you will get the same annual total return as you did get over those 100 years. Paying 15 meant that you got a 10% annual total return previously, and all things equal, paying 15 times earnings now means that you will get a 10% annual return, or let's call it an 8% real return every year, meaning you get a doubling in wealth over less than 10 years, but let's say 10 years, 9 years actually. That is what it means to pay an absolutely cheap valuation. It means that you know that everything, all else equal, you will get a positive, high, real adjusted, real return on your investment, meaning your wealth increases so you can buy more stuff, more entertainment, more housing, more transportation, more traveling and vacations than you otherwise would. That is what it means to get a real positive return. And that is what you get for sure if you pay absolutely cheap valuation multiples. Paying relatively cheap only means that you will do better than average at that certain point in time. But if the entire market is expensive and you buy a little bit cheaper, you might still lose money, nominally, really, and just lose money, period. So paying relatively cheap, but absolutely high, that is a risky prospect and nothing to recommend for the long-term investor. Then it's better to wait for a so-called fat pitch. A fat pitch is when the thrower, the pitcher in the baseball, he's throwing something that is really easy to hit. And it's so easy to hit that the ball looks fat, like you just can't miss it. And that's when you swing for the fences and you give it all you got. And you want to wait for that fat pitch. And a fat pitch is something that looks cheap from an absolute perspective. And that is when it's time to not be a timid little rabbit anymore, but swing for the fences.